Something happened in Dubai that the mainstream media is barely covering. And what happened next in the silver market? Nobody is talking about it. I'm going to show you exactly why the most unthinkable financial setup of the decade is playing out right now in front of your eyes. While you were watching breaking news alerts about explosions near the US consulate in Dubai, smart money was quietly doing something extraordinary, something that happens once every few years. And if you don't understand what's going on, you're going to miss it completely. Right now, silver just spiked to $96 per ounce. Then, it crashed back to $83 in what looked like a meltdown. Was it panic? Was it manipulation? Or was it a plan? I'm going to walk you through the geopolitical firestorm that triggered all of this. Then I'm going to show you the data that Wall Street does not want you to see. By the end of this video, you'll know the real plan. You'll know why 2026 could change everything. And I'll tell you exactly how I'm positioning my own money. Right now, stay with me. This is the one you don't want to miss. Let's start with what happened in Dubai. Day 6 of Gulf escalation, and the Iran's Revolutionary Guard dropped a bombshell announcement. They claimed a massive coordinated missile and drone strike on US military targets in Dubai. Tehran state media was reporting dozens killed. Fires spotted near the American consulate, chaos on the ground. The whole region held its breath. Now here's where it gets interesting. Washington's response was almost calm. US officials downplayed the casualties immediately. They called Iran's claims grossly exaggerated. They said the situation was contained. But think about that for a second. If it was nothing, why were markets already screaming? Silver didn't wait for clarification. Silver spiked from around $78 straight to $96 per ounce in hours. That is a 23% move in a single session. That kind of move doesn't happen on noise. That happens when institutional players smell something real. Gold surged too, oil jumped, safe haven assets across the board lit up like a Christmas tree. Then something weird happened. Within 24 hours, silver crashed, not dipped, not corrected. Crashed back down to $83, then $84, a 13% reversal in less than 2 days. The headlines called it a fade, they called it profit taking. But I'm telling you, this was not random. Let me show you who did this and why. Right now on the COMEX, the exchange where silver futures are traded, the paper to physical ratio is sitting at 365 to 1. Read that again. For every single ounce of real physical silver available for delivery, there are 365 paper contracts floating around, 365 promises backed by almost nothing. That is not a market, that is a pressure cooker. And it gets worse. Silver inventories at the COMEX have been falling for years. We are in the 6th consecutive year of supply deficit. 6 years where the world consumes more silver than it mines. In 30 days alone, silver dropped 26% from its local highs before the Dubai spike. JP Morgan, yes, that JP Morgan has been accumulating physical ounces quietly for months. Not paper contracts, physical bars, the kind you can hold. Why would the biggest bank in America be loading up on physical silver while pushing the paper price down? Because they know what's coming, and that's exactly what I'm going to break down for you right now. Let's zoom out first, because the Dubai strike and the silver crash are not separate stories. They are the same story. And to understand it, you need to understand the 4 forces that are about to collide in 2026. Force 1, currency debasement and de-dollarization. Force 2, the industrial demand explosion. Force 3, supply crisis and geopolitical risk. Force 4, the gold-silver ratio reset. Let's go through every single one. Here's the thing nobody wants to admit. The dollar is being slowly destroyed from the inside. Since 2020, the U.S. money supply expanded by over $8 trillion. $8 trillion printed into existence. Every dollar printed makes your existing dollars worth less. That is not conspiracy theory. That is basic math. And now the world is responding. China and Russia are settling oil trades in yuan. Saudi Arabia is in active conversations about pricing oil outside the dollar. The BRICS nations, Brazil, Russia, India, China, South Africa, are building alternative payment systems as fast as they can. De-dollarization is not coming. It is already here. And when the dollar loses its reserve status grip, hard assets explode. Gold explodes. Silver explodes. This is not a maybe. This is a historical pattern going back 500 years. Every time a reserve currency collapsed, hard money won. Every single time. Now add the Iran-Dubai situation on top. Geopolitical risk is the Gasoline on this fire. When Tehran fires missiles at us interests in the Gulf, the message to the entire world is loud and clear. The old order is cracking. The dollar's military backs top America's ability to project power in the Gulf and protect oil flows is being challenged openly. That is not bullish for paper money. That is explosive for silver. Now here's the part that doesn't make the news but should. Silver is not just a monetary metal anymore. It is the most industrially critical metal of the 21st century, and the demand is about to go vertical. Think about what the world is building right now. AI data centers running 24/7 require massive electrical infrastructure. Every server rack, every cooling system, every high-performance connection uses silver. Solar panels. A single solar panel uses about 20 grams of silver. The world is installing hundreds of gigawatts of solar every year. Do the math. Electric vehicles. Each EV uses roughly 25 to 50 grams of silver. The EV revolution is in its early innings and production is scaling globally. 5 grams infrastructure rollout, medical devices, aerospace technology. Silver's conductivity, reflectivity, and antibacterial properties make it irreplaceable. There is no substitute. You cannot swap silver out for copper in a solar panel and get the same performance. You cannot replace silver contacts in an EV battery management system without degradation. This is a metal the modern world cannot function without, and here's the warning. Demand from these sectors is projected to grow 20% annually through 2030. Meanwhile, silver mining output is basically flat. Mines are aging. New discoveries are rare. Permitting new mines takes 10 to 15 years. The supply is not coming. The demand is exploding. That gap has to be filled somehow. And the only way to balance that equation is a dramatically higher price. Let's talk about the supply side more specifically. Global silver mine production has barely grown in a decade. The top producing countries, Mexico, Peru, China, Russia, are all facing their own challenges. Mexico is dealing with security crises in mining regions. Peru has ongoing protests and mine shutdowns. Russia is under sanctions, which disrupts the global supply chain. China is consuming most of what it produces domestically, and the recycling pipeline's secondary supply from old electronics and industrial scrap cannot scale fast enough to meet demand. Now layer in what's happening in the Middle East. The Iran situation in Dubai is not just a news story, it is a signal. A signal that the Gulf, the backbone of global energy markets, is entering an extremely unstable phase. If the Strait of Hormuz gets disrupted even temporarily, oil shocks globally. Oil shocks cascade into inflation. Inflation destroys confidence in paper money. And when confidence in paper money breaks down, people flee to silver. And gold, we saw a preview of this in the $96 spike. Imagine what happens if the conflict escalates further. Imagine what happens if the dollar faces a genuine credibility crisis. The $96 spike was just the trailer. The movie hasn't started yet. This is the section I really want you to pay attention to, because the numbers are shocking. Right now, the gold-silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold, is sitting around 88 to 1. Historically, that ratio averages around 55 to 1 over the long run. In ancient Rome, it was 12 to 1. In the ground, the ratio of silver to gold is roughly 8 to 1. When the ratio normalizes even to the modern historical average of 55, with gold at $3,200 per ounce, silver should be trading at over $58. But silver bulls are not targeting 55. They are targeting the industrial demand premium on top of the monetary reset at a 40 to 1 ratio, which we hit as recently as 2011 silver would be at $80. At a 30 to 1 ratio, which we saw in 1980 during the Hunt Brothers era, silver would be at over $106, and some analysts looking at the full picture of supply deficits, de-dollarization, and industrial demand are targeting $120 to $150 by end of 2026. That is not a fringe prediction. Goldman Sachs has silver in their commodity upside scenarios. Bank of America published a $50 silver target before the recent geopolitical spike. We already blew past $50 during the Dubai escalation. The institutions know. The question is whether you know. Here's what I believe happened with the $96 spike and the crash to $83. This was engineered. I want you to really hear me on this. Big players, banks, funds, the same entities running those 365 paper contracts per ounce needed to accumulate massive quantities of physical silver at cheap prices. They couldn't buy at $78 without moving the market against themselves. They needed a reset. So here's what a coordinated pullback looks like. Step 1. Let geopolitical fear run silver to $96. Step 2. Flood the paper market with short contracts at the top. Step 3. Trigger stop losses, create panic headlines, shake out retail holders. Step 4. Buy physical silver at $83 to $84 while retail is selling. In panic. Step 5. Remove the paper pressure and let the real supply-demand fundamentals reassert. Step 6. Watch silver go to $120. This is the oldest playbook in commodities markets. It happened in 2011 when silver went from $50 to $26 in weeks, then spent years quietly being accumulated before the next leg higher. It happened in 2020 during COVID when silver crashed to $11 before exploding to $30. The pattern is the same. The actors are the same. The opportunity for you is the same. The crash was not the end of the silver story. The crash was the on-ramp, and the Dubai situation has not resolved. Day 6 of Gulf escalation with no clear diplomatic path. Iran is still making noise. The US is still projecting force. And every day this drags on, the geopolitical war premium stays in the market's memory. The next spike will not be as easily faded. So what do you actually do with all of this? Let me tell you exactly how I'm thinking about this. First, physical over paper, always. If you buy a silver ETF or a futures contract, you are playing in the 365-to-1 game. You are a passenger. Physical silver coins, bars, rounds from trusted dealers, that is your actual asset. That is what cannot be vaporized by a bank running a short squeeze against you. Second, cost average. Don't try to time the exact bottom. Nobody catches the exact low. Not me, not the banks, not anyone, by a fixed dollar amount every month. When price drops to $83, you get more ounces. When price rises to $100, your existing stack is worth more. This smooths out the volatility and takes emotion out of the equation. Third, allocate a percentage you can hold for 18 to 36 months without needing the cash. Silver can be volatile. If you buy at $84 and it drops to $72 before heading to $120. Can you hold? Only invest what you can genuinely leave alone. Fourth, know your dealers. APMEX, JM Bullion, SD Bullion, local coin shops with strong reputations, verify premiums, verify authenticity, understand buyback policies. Do not buy from random eBay listings or unknown online stores. Fifth, stay informed. The Dubai situation is still evolving. COMEX inventory reports drop every week. The gold-silver ratio changes daily. Join communities of people watching these same signals so you're not reacting alone in the dark. This is not the time to be flying blind. Let me bring this all together for you. Iran Zerg claimed a massive strike on US targets in Dubai. The region is on edge. The US is downplaying it, but the market already told you the truth. Silver went to $96 on pure fear. Then it crashed to $83 on what I believe was a coordinated engineered pullback designed to let big players accumulate physical at bargain prices. Meanwhile, the fundamentals have never been stronger. 6-year supply deficit. 365 paper contracts per physical ounce, industrial demand from AI, solar, and EVs growing 20%. Annually, de-dollarization accelerating. Gold-silver ratio math pointing to $120 plus, and a geopolitical powder keg in the Gulf that has not been diffused. The crash was not the end. The crash was the setup, and 2026 is shaping up to be the year when all of these forces converge at once. The people who understand what's happening right now and position accordingly are the people who will look back at $83 silver and wish they had bought more. Don't be the person who watched it all happen and did nothing. In the next video, I'm going to go even deeper. I'm going to show you the exact COMEX inventory data that is signaling an imminent physical delivery crisis. And I'm going to show you what happened the last 3 times these exact conditions lined up. You do not want to miss that one. If this video gave you value, hit the like button right now. It takes 2 seconds and it genuinely helps this channel reach more people who need to hear this. Subscribe and hit the bell. Because when the next move happens, you'll want to know before the headlines catch up, and drop a comment below. Tell me, are you already holding physical silver? Or are you just getting started? I read every comment and I want to know where you're at. This is the information they don't want widely shared. Share it with someone who needs to hear it. Stay stacked, stay sharp, and I'll see you in the next one.